And welcome to my presentation. I'm James Willoughby, the market analyst for the International Tin Association. Apologies that I couldn't make it to the event, but hopefully this recording of my presentation should help to give you some idea of ITA's view of the tin market going forward in the rest of this year and also into 2020. So to just illustrate how difficult this year has been for the tin market, I wanted to look at the LME 3-month settlement price. Now on this chart on the left here, I've indexed the prices to the first working day of the year for both 2018 in blue and 2019 in red. Now what you can see is a peak in the prices around Q2, a general decline into Q3, and then a steady price in Q4, and that was definitely the trend last year, and you can see it illustrated rather well here. Now this year the story's actually been quite different. Although the general trend was followed throughout Q1 and Q2, what we're actually seeing throughout Q3 and into Q4 is a significant deviation from that usual trend towards the negative. Now that indicates significant disruptions to the global tin market, and hopefully I can use some of our demand and supply statistics to really illustrate why that is. So on the demand side, we also see a typical pattern throughout every year, and that is a peak in Q2, a slight decline in Q3, and then stability into Q4. And you can see that illustrated well in 2017 here in the black line, but also quite well in 2018. However, towards the end of last year, we had the tariffs come in related to the US-China trade war, and that significantly knocked tin demand. While many of the tariffs don't directly relate to tin products, the uncertainty that they cause has really changed people's view on the market and caused them to use up more of their tin stocks than they would have usually. What this has meant for 2019 is that we're starting at a lower base, but also on top of that, you can see here on this chart that demand actually failed to peak in Q2 or early Q3 as it would normally do, and that's really hampered the price and general sentiment around the tin market this year. Now what you can see here is really just a different way of explaining how demand has grown this year. What we have is the quarter-on-quarter growth rates for tin demand. The grey area on the chart represents the standard deviation of growth rates over the last 20 years. What you can see is there's a fairly usual pattern whereby there's a peak in Q2 and then tin demand is relatively stable in Q3 and Q4 of any given year. The blue line is the actual growth rate for the dates given at the bottom of the slide, and you can really see the impact that the trade tariffs had on tin demand. It fell by roughly 6% during the fourth quarter of last year. What's interesting to note is that this year growth rates have actually been within the expected range. We did see what was a peak in Q2, but actually this was relatively low compared to some of the highs that we've seen, particularly last year when quarter on quarter growth grew by about 8%. Now last quarter tin demand was down slightly, but moving into the fourth quarter we're actually expecting demand to pick up or be relatively stable moving forward because of some of the indicators that we follow in the global markets. Now I'd just like to talk you through some of those indicators that we follow to try and give you an idea of why we're thinking that the tin market will be more stable into the last quarter of this year. One of the main indicators that we like to use is the Purchasing Managers Index, or PMI, specifically that for manufacturing. This index takes into account new business orders, growth in imports and exports, that sort of thing, as well as business confidence. The y-axis here, I've highlighted the value of 50 because this value is rather key to this index. Above this value indicates market expansion, less than 50 indicates contraction in the manufacturing sector. Now what you can see here is over the last year and a half, generally the manufacturing PMI values have been on the decline. The US, the Eurozone, China and Japan have all seen these values trending towards 50, which indicates market stability. Now I've just highlighted the most recent values at the end of the chart here, and you can see that in China and the US there's some pickup in the manufacturing sector, particularly in China where over half of tin is used. This is really important as it's indicating slight growth into the fourth quarter. Of course, we all know that the Eurozone is doing quite badly this year. It's been hounded by tariffs directly from the US, as well as being affected by other changes to supply chains globally, and of course it's being impacted by Brexit. This is continuing to fall, and we would expect demand in the Eurozone to be quite weak into the fourth quarter. But actually this market is relatively small compared to China, and the positives in both China and the US outweigh the slight negatives in Japan and the Eurozone. Another indicator that we follow is industrial production growth. Now, what I've plotted here are the month-on-month changes in industrial production growth, and then I've just taken a linear projection of these values moving forward. Now, what you can see is that for China and the US, we're expecting some stability or even slight growth. But for Europe and Japan, again, as with the PMI values, we're actually expecting a slight decline in the industrial sector. Now, as I mentioned before, China and the US outweigh Europe and Japan combined, and therefore we're slightly more positive on the tin market moving into the fourth quarter. Now, some of these gains in China are due to the growth in the electronics sector. Now, what I've plotted here in the faded colours are all of the different types of electronics that we follow, including washing machines, air conditioners, but also different consumer electronics such as personal computers. Now, I've just taken the average growth rates of these two different sectors, white goods in the dark red and consumer electronics in the dark blue, and plotted those here. Now, what you can see is that for white goods, the growth rate has actually recovered from a rather poor 2018 and has actually been tracking growth throughout the entirety of 2019. It's averaging around 5% growth, and we're quite positive on that sector. Consumer electronics has been slightly worse this year, although not as poor last year. What you can see at the end of this chart on the right hand side is that the consumer electronics market is declining slightly. We believe that that is just a seasonal variation. The balance in terms of tin for these two sectors is quite different. The white goods sector uses a lot more tin per unit, and therefore we're a lot more positive on the Chinese electronics sector, and therefore Chinese tin demand going into the fourth quarter. Now, we don't just use indicators to judge tin demand, we do also survey tin users. We've done this for the last 15 years, and these are the results of our latest tin use survey. Now, what you can see here is that globally, tin users are expecting a 2% decline in tin demand. This is simply the tin that they're using to produce solders or chemicals or lead acid batteries, all of the different end use sectors that you can see on the left hand side of this table. Now, what we're actually predicting is a slightly larger decline in tin use this year, maybe around 5%, because of the quite negative sentiment we're hearing from traders, but also this survey represents around 40% of the global tin market, but doesn't include some of the larger manufacturers, particularly in Europe and particularly in the tinplate sector. Now, we have reports that particularly the EU tinplate sector is doing quite badly this year, along with EU automotives, those sort of markets. So we expect this number to actually be slightly worse this year. Now, although most end-use sectors are declining this year, there is one bright spot, which is the lead-acid batteries market, which is growing in China and outside of China, averaging around 1% growth globally. Now, although the automotive market is quite poor this year globally, lead-acid batteries have quite a strong replacement market, and so it's a bit more immune to some of the disruptions going on to global markets. Now, on the other side of the market, of course, we have tin supply, and this also follows a general trend throughout the year, again similarly to demand, peaking in Q2 or Q3 and then falling off quite dramatically towards the end of the year. Now, this year we've followed previous curves quite closely. You can see that supply peaked in Q2 this year. However, with demand being so weak, producers are calling for production cuts, and if these do come into effect, we will dramatically lose production, around 6 to 8% of global annual production during the fourth quarter. Now, in terms of the market balance, you can see in the upper chart here on the left, supply versus demand, demand being in red. And you can see the quite significant difference between our supply forecast and our demand forecast moving into the fourth quarter. At the bottom here, you can see the global market balance. Now in Q1 we were in quite a large deficit because of issues relating to Indonesian exporters. Many of the private smelters are no longer able to export, and although a lot of this production has been taken up by PT Timah, the first quarter production was significantly lower than it would usually be. Moving into Q2 and Q3, supply actually overshot demand and we were in a slight surplus throughout both of those quarters, and we would expect to be in a significant deficit again if these production cuts do come into effect. Now you'll remember earlier I showed the graph of the tin price that declined quite significantly but then fell off dramatically during the third quarter away from the usual trend. And that's simply because the demand that we're showing here isn't equal to tin trade. We understand from our survey and from talking to other tin users that consumers are using significant amount of stocks this year, maybe around 3% of global tin demand, and that has seen the spot market dissolve this year. It's really put traders under quite a lot of pressure. However, if the deficit does come into effect in the fourth quarter, we would expect a rebound to the price, but obviously it remains to be seen whether demand will be as stable as we're forecasting and whether producers will actually cut production. I know there's quite a lot of uncertainty surrounding particularly Indonesian production. Now I mentioned stocks. I mentioned that consumers were using quite a lot this year, but these are invisible stockpiles held by these companies as opposed to warehouse stocks, which you can see the LME stocks during the last 5 or 6 months on the left hand side here. Now what I've plotted on top of this is the spread between the cash and the 3-month price. Generally tin trades at a backwardation which was quite significant during the second quarter this year, flaring out to around $400 per tonne. What we've seen in the last few months though is a trend towards contango. People are more certain of supply now compared to supply in the future, and that has seen tin stocks starting to slowly come down as people feel the need to shore up their own personal supplies. However, this year's stock peaked at around 7,000 tonnes on the LME, and at the rate at which it's declining we wouldn't expect it to drop below 5,000 tonnes this year, despite having reached less than 1,000 tonnes earlier in the year. So just to summarise our outlook for Q4, some of the key indicators are pointing towards stabilisation. Both the manufacturing PMIs and industrial production indicators are showing stability or a slight uptick, and the electronics market in China, which is a significant market for tin, is also very positive this year. What is also important to point out is that even though this year has been relatively poor in terms of demand, it's actually growing as we would have expected quarter on quarter. It's just growing from a very low base due to the drop-off in demand at the end of last year. Now this won't be good news for traders, even so, because as I mentioned, consumers are using a lot of stock, and that hasn't necessarily translated across into deals for traders. However, I have to caveat all of this by saying this remains a forecast. There is still a lot of volatility in the global markets. Although the US and China were claiming to have signed a deal by the 1st of November, this hasn't been signed, it's been postponed, and there's talk now of China being uncertain over the long-term future of that deal. There's also uncertainty on the supply side of the market surrounding the production cuts, particularly from Indonesia, although we know that production in China this year is already down around 8% year to date. So I just want to look ahead now to 2020 and give you our view on markets during the next year. In terms of supply of tin concentrates, we're expecting a slight increase next year of around 7,000 tonnes. Now increases in China and Africa will balance the decline in Myanmar, which is expected to decline by around 7,000 or 8,000 tonnes. The increase in Chinese production is actually the restarting of the Bayanchagan mine, which closed earlier this year due to a mine accident. So if we take that out of the equation, actually we're only seeing a net gain of around 2,000 tonnes of tin concentrate next year. Now, that was just planned capacity expansion, and what we have here is a cost curve for all tin mines globally. What I've plotted here in the red dashed line is the 90th percentile cost, what we would call our floor price. When prices dip below this point, it actually puts quite a lot of production under pressure, and at prices that we're seeing at the moment, around 16,800 US dollars a ton, that would actually put around 15% of global production under quite significant pressure. However, that doesn't necessarily mean that production will shut down next year because of the price. Some of the higher cost operations that you can see in the dark blue representing Indonesia are actually supported by some of the lower cost operations in the 10th percentile, but also in the middle of the cost curve. And actually the true value of those Indonesian producers is probably somewhere around 50 or 60% of global mine production, somewhere in the middle of this cost curve. So yes, production will be under pressure next year in terms of prices, but we're not seeing any significant production coming off because of the price in terms of large mechanized mines. Artisanal mining is always a different story. It's quite strongly related to the price, and if prices continue to remain low, we wouldn't expect artisanal mining to come back online, as it's already fallen away this year because of the low price. Now, in terms of demand, there are many different scenarios that could happen next year, but our central forecast indicates around 0.4% growth in 2020. Now, we're predicting this because there seems to be a consensus that the global market, global growth will recover during the second half of next year, but we see slightly weaker tin demand generally, so we're predicting slightly less than half of the usual growth rate for tin, which is normally around 1.8%. Now, what you can see in this scenario analysis on the left is that there's a lot of risk to the downside. A no-deal Brexit, a US recession, and a recession outside of the US could all decrease demand growth next year. On the upside, we're expecting China's stimulus to come in the form of new construction projects, that sort of thing, which actually has a strong impact on tin demand during that year. A recovery in the German automotive market would also be slightly positive for tin, but actually it's a relatively small market relative to global tin demand. What's important to point out here is that actually all of these factors could come into effect during the same year. We could have a combination of factors, and particularly the US recession is likely to have a knock-on effect on the rest of the world and could then cause a recession outside of the US. Generally though, we think that our central forecast is the most likely scenario next year, although there is quite a significant risk on the downside. So what does that mean in terms of the market balance next year? Well, if all new mine production that's forecast to come online next year does come online, we're expecting there to be perhaps a slight surplus in the market. What I've plotted here on this graph is mine production as well as secondary refined tin production against refined tin consumption. But what's important to note is that smelter recoveries aren't always 100%. They generally trend around 95-96%, and so these figures of mine production aren't directly translatable to refined tin production. Moving out to 2023, we actually see a widening market deficit comparing likely new mine production to refined tin consumption in the dashed blue line here. What this means is we've taken new mines that are in the pipeline and assessed how likely they are to come online, and we've seen that actually there are relatively few projects that have significant backing at the moment to come online during this time frame. Of what you can see from the lighter pink is that if prices do pick up, there is a lot of production waiting in the pipeline that could come online with significant investment. Of course, due to the relationship between artisanal mining and price, I haven't included that in this graph. There's a lot of volatility related to these factors. Obviously, if the tin price were to increase dramatically in one year, we would expect production to come online quite quickly from artisanal miners during that year and possibly the next year. However, the key takeaway from this graph is that in current market conditions, we would expect refined tin consumption to outweigh sources of tin out to 2023 and for there to be a deficit in the market from 2021. So to summarise our forecast for 2020, it's still quite unclear. There are some recovery indicators, but a lot of this relies on what happens to the US economy, what happens between the US and China. There's lots of different factors that could impact tin demand next year. However, if our central forecast is true, then we would expect a slight increase in demand next year, although there is likely to be a surplus in the market. Longer term, we think the fundamentals are extremely strong. Tin is used in cars, in houses, and in electronics, and these are all things that people buy, no matter what the global economy is doing. And long term, we see around a 2% growth annually. Looking further out into 2025, 2030, we're expecting the solder market to recover from miniaturization of electronics and for the solder market to grow in line with growth that we've seen in that market over the last 10 or 15 years, which is around 5%. In 2030, we're expecting future technologies to come in for 5G to really start impacting the global market, as well as electronic vehicles and lithium-ion batteries to be quite positive for tin demand. However, in the near-term future, out to 2021, we're expecting growth in new mines to outpace demand. Further out, we're expecting demand to outpace new mine production. And for any new mines to come online, we're expecting these to only stabilise the decline in existing mines. We're expecting new sources of tin will have to be found, and we expect secondary tin production to increase going into the future. That's it for my presentation. If you have any questions about what I've presented or anything about the global tin market, feel free to contact me at my email address, which I will provide to our hosts today. Thank you very much for listening, and I hope you enjoy the rest of the event.